NIO's stock price has been through one of the toughest stretches investors have seen in a long time. The share price has slid from the mid-teens to the mid-fives, sentiment has deteriorated, and macro pressure on Chinese equities has remained consistently heavy. For many investors, it feels like NIO has been stuck in reverse. But if you step back from the short-term volatility and examine what the company is actually doing behind the scenes, a different picture begins to emerge. NIO appears to be quietly preparing for a major strategic reset going into 2026, and the foundations for that shift are already being built right now. This reset isn't about a single model. It isn't about a single earnings report. It isn't even about the stock price. It is about a company reorganizing itself to operate with multiple brands, multiple regions, multiple price tiers, and an ecosystem strategy that is far more comprehensive than what the early years of NIO ever suggested. In many ways, NIO has spent 2024 and 2025 laying the groundwork for a business model that will look very different in 2026. The market is reacting to today's fear, but the company is building for tomorrow's structure. One of the clearest signs of this reset is NIO's evolution from a single-brand automaker into a multi-brand company. For years, NIO operated solely as a premium EV manufacturer. The vehicles were high-end, the features were sophisticated, and the brand focused on design, user experience, and battery swapping. But the introduction of Onvo, the family-focused mid-market brand, and Firefly, the compact mass-market brand, signals a fundamental transformation in the company's business model. In 2026, NIO will not be selling vehicles through just one brand. It will be operating 3 distinct brands across 3 different segments, allowing it to reach a dramatically larger consumer base. The strategic reset becomes even more apparent when you look at the markets NIO is preparing to enter. The Firefly brand has already started right-hand drive production, with the first vehicles heading to Singapore. This development unlocks access to markets that NIO has never been able to reach before. Countries like Australia, the United Kingdom, Japan, New Zealand, and parts of Southeast Asia all require right-hand drive vehicles, and they also tend to prefer smaller, more affordable EVs. That makes Firefly perfectly suited for these regions. For NIO, 2026 may be the year where global expansion truly accelerates. Rather than focusing on a handful of European markets with premium models, NIO will be entering entirely new regions with products tailored to local preferences and price points. The multi-brand strategy also aligns NIO with global automakers that have historically succeeded by segmenting their offerings. Companies like Toyota, Volkswagen, and Hyundai built their scale by serving multiple market layers. NIO adopting this strategy is not a defensive move, it is a growth-driven one. Another piece of the 2026 reset involves infrastructure. NIO now operates thousands of global fast chargers and over 2,000 battery swap stations. These aren't just service stations, they're long-term strategic assets. By expanding the battery swapping network, NIO is building a moat that differentiates it from every other automaker that relies solely on plug-in charging. Battery swapping reduces downtime for drivers, increases customer loyalty, and creates a recurring revenue model through subscription or pay-per-swap services. By 2026, NIO's 4th-generation swap stations should be widely deployed. These stations are faster, cheaper, more automated, and more efficient. They reduce NIO's operating costs while improving the customer experience. As NIO expands its presence with multiple brands across multiple regions, the battery swapping network becomes a core part of the company's ecosystem strategy. It is something Tesla, BYD, and other automakers do not currently have on a comparable scale. Another major element of NIO's strategic reset revolves around cost efficiency and margin recovery. In recent years, NIO has struggled with high cost structures, aggressive competition in China, and the need to invest heavily in research, development, and infrastructure. But those investments are now transitioning into the phase where they can produce returns. NIO's internal component development, platform consolidation, and supply chain optimization efforts are all expected to reduce manufacturing costs over the next 2 years. The company is increasingly producing its own components, integrating technologies vertically, and refining its supply chain. These improvements don't impact the stock price immediately, but they enhance profitability in the medium term. By 2026, NIO aims to operate with stronger gross margins, more efficient production processes, and higher output capacity. The timing aligns with the launch of new models across all 3 brands and the expansion into new markets. We also need to consider software. NIO has invested heavily in its operating system, its smart driving platform, and its vehicle intelligence features. As these systems mature, NIO gains the ability to introduce subscription services, enhanced driver assistance packages, and advanced software upgrades. Software margins are significantly higher than hardware margins. As NIO grows its fleet and expands globally, software and services could become a meaningful part of its revenue stack. By 2026, NIO's software ecosystem may be one of the key drivers of its profitability. Another major reason 2026 is shaping up to be a reset year is the company's focus on ecosystem unification. NIO is no longer just a car company. It operates energy services, charging solutions, battery swap subscriptions, smart driving systems, and multiple brands that all plug into a common ecosystem. This combination resembles the business model of a technology company rather than a traditional automaker. The broader the ecosystem grows, the more locked-in customers become. The more locked-in customers become, the more stable NIO's long-term revenue becomes. Financially, the company still faces challenges. Losses remain high, price competition continues to squeeze margins, and the share price has not reflected any of the operational progress. But this disconnect between short-term market sentiment and long-term strategic direction is exactly why 2026 could represent an inflection point. As the multi-brand strategy gains traction, as new markets open, and as cost efficiency improves, the company's financial profile should begin to shift. Meanwhile, NIO's core brand continues to show signs of strength. Recent delivery months have been exceptionally strong. The ES6 has surpassed 300,000 cumulative deliveries, and customer satisfaction remains high. These aren't numbers associated with a company in decline. They're numbers associated with a company that is maturing and preparing for broader scale. The stock price may not reflect this yet, but the underlying business continues to expand. A strategic reset is not something that happens overnight. It takes months or years of preparation. What NIO has been doing throughout 2024 and 2025 is building the foundation for a larger global presence and a more diversified brand portfolio. Investors who only look at the daily share price movements miss the fact that the company's long-term trajectory is being shaped right now. Markets are cyclical, and sentiment eventually turns. When it does, companies that have positioned themselves strategically tend to benefit the most. Right now, NIO stock is priced as if the company is struggling for survival. But the actions NIO is taking, launching new brands, entering new markets, building infrastructure, improving cost structures, and expanding globally, are the actions of a company preparing for growth rather than contraction. When 2026 arrives, NIO will be operating with a stronger product lineup, a deeper global footprint, improved efficiency, and a more powerful ecosystem. It will no longer be a premium-only brand. It will be a multi-tier automaker with offerings across the market spectrum. It will be a global EV manufacturer with the ability to compete in regions it previously couldn't access. And it will be a technology-driven company with an expanding service and subscription layer. The market may not be pricing this future in today, but long-term investors should be paying attention to the foundations being set. A strategic reset is a slow build-up that only becomes obvious in hindsight. 4-0, the pieces are falling into place. The next chapter is forming. And by the time the market recognizes the shift, the opportunity may already be priced in.